Come on, buddy. All right. Think I'm recording now. At least I hope so. Let me check. Yes, we're recording now. All right, we're doing personal finance, chapter 17, static problems with the video. So once again, chapter 17 is our last investment chapter. It is real estate and alternative investments. Okay, real estate and alternative investments. And just like we've been learning, most of the time we're going to evaluate how much we paid for something, how much it's worth later, or how much we're selling it for later. So in this first problem, we're trying to find the return on investment, the percentage, right? So if Dave bought a rental property for $300, so you would want to put down $300,000 as the original investment, and we're going to use that as the divisor, and then put how much he sold it for a year later, okay? The dollar amount of return, which is not what they're asking for, but it's always good to know what that is. He made a $60,000 profit or a gain on the sale of that property, right? When he turned around and sold it a year later, that's pretty good. That's pretty good money, right? Making $60,000 on an investment in 1 year, right? So what is the percentage then of that return? So then you would take the $60,000 return amount and divide it by your original purchase, right? So we're looking at a 20% return on investment, okay, 20%. So I don't think you'd find a whole lot of other investments that are going to have a return like that. Property right now is pretty good return. I think property values are starting to slow down now because not as many people are buying houses because interest rates haven't come back down yet. I don't know if they will. I am betting that the Fed will not bring them down in December. That's what my bet is. We'll see if I'm right. I don't usually speculate. I guess I'm going out on a limb here. All right, let's go to the next one. Next kind of deal, right? So now this one is a little weird. I don't know if I like it, but all right, same kind of deal. We purchased property for $300,000, and sold it for $360,000. So that has not changed. But Dave invested only $30,000 of his own money and borrowed $270,000 interest-free from his rich father. Anyway, what was his return on investment? I disagree with this one. I don't like how they're saying that just because he had this much of his own money, he had to have that other borrowed amount. It doesn't really matter who you're borrowing from. He might have borrowed from the bank. You know, to me, it doesn't really matter who you're borrowing from, but I guess I might not be looking at it the right way. So anyway, here's how it works. $30,000 was his money, right? And then $270,000 was interest-free loan. Yes, it has to be paid back, but anyway, so if you just looked at the return on the investment, it would be the 20%, just like before, if you use the whole amount, right? But if you only use the amount that he invested, which is $30,000. So he took $30,000 of his money and turned it into $60,000. I don't really think he should get to count all 60,000 because the 60,000 was made because he put 300,000 in. Are you with me? He should only get to count 20%, I think 20% of, anyway. to me, this is not a good problem, and I'm not quite understanding what they're trying to prove here. Because, like I said, if he wouldn't have put that whole 300,000, he would have never made the whole $60,000 profit. I'm gonna stop right there. If that doesn't make sense to you, that's okay. But that's the thought that I'm having. So anyway, they want you to take 30,000 and divide it by the original. Oh, I'm sorry. They want you to take the $60,000 return on investment, because that is the amount that you made because you bought the property for 300,000. Now they just want to look at it with just his investment of 30,000, and it makes it look like the return is just huge. Okay, so there it is. It's actually a 200% return, and I disagree with that because, like I said, so I know I could stand here and argue that all day, and I don't know for sure if there's something I'm not thinking of, but if you just take his 30,000, because he's got to, like I said, it doesn't matter that he's got to pay it back. He had to have that full 300,000 in order to get that $60,000 gain. So I don't see that as his personal return on investment. Anyway, onward we go. Okay, so I think that's what we want, or that's what they want in this problem. And maybe someday I'll have the time and the energy to argue with them about that. But I don't think that's a very good problem to display. Yeah. All right. Back to it. Okay, number 3. Let's go to number 3 now. Okay. So now Ranny bought a rental property for $100,000. So the purchase is $100,000. Later, she sold the building. Now it says with no borrowed funds. All right. Later, she sold the building for $120,000. What is her return on investment? So she had a profit of $20,000. $20,000 divided by the original amount of return is 100,000. So once again, this should be a 20% return on investment for that problem. Okay. Number 4. It says, suppose Shane invested just 10,000 of his own money and had a $90,000 mortgage with an interest rate of 8.5%. After 3 years, he sold the property for $120,000. What is his gross profit? Okay, so let's write it down. Okay, let's write it down and see if we can't figure this out. If you're going to put 10% down on a property that costs 10,000 plus 90,000, that's $100,000 property. You agree with that? Yep. If you put $10,000 down on a property and then take out a mortgage that's $90,000, then that is $100,000 purchase price. Okay. And once again, I have it noted here that 10,000 is his own money and 90,000 is the mortgage. So that's how I'm getting the 100,000 for the original purchase amount. And then 3 years later, he sold it for 120,000. So the gross profit, now notice, gross profit is dollars. Okay, gross profit is dollars, unless they say gross profit percentage or gross profit yeah, let's just go with what they say. All right. So they just want to know. So over 3 years, they made a gross profit of $20,000. Then the next piece is, what is his net profit? What is his net profit? So what you've got to do is take that $90,000 mortgage, right? And if you're being charged 8.5% interest per year, and he held on to that mortgage for 3 years before he sold it, we need to calculate the interest. Okay, the interest for those 3 years, right? So if you take $90,000 times 0.085, okay, and then times 3 years. Okay, so let me double check that I've got my formula in here correctly. So 90,000 times 0.085 times 3. Okay, that means here's how much he spent in interest to make this purchase happen, and he waited 3 years for the value to go up. What happened? The interest rate was higher than how quickly the value went up of the property, correct? So he ended up spending more to do this than the gross profit turned out to be. Are you with me? So actually, he's got a net loss there. So he spent $2,950 more than his gross profit, which things happen sometimes. All right, so let's put the net loss. Okay, there's a net loss there because of the interest rate. Okay, it's a net loss, and it says we should put that in with a minus sign. So make sure you do. $2,950 is the net loss. And then the percent return on investment. So just because you have a net loss doesn't mean you can't figure the return on it. Okay, it's just a negative return. So in fact, if you take the net loss and you divide by his own money of $10,000, okay, you get a negative 29.50%. That's called a percent return on investment, but it is a negative. It's a negative one, but you still calculate it the same. So it's the amount that was made, which is a loss, negative because it's a loss, negative due to loss. Okay, so we're going to put in 29.50, and it says negative amount should indicate by a minus sign. So this time they do want us to put the negative in with the decimal. So 29.50 is the percentage of the return on investment. Okay, so, you know, we've looked at a lot of returns that were positives, and they don't always happen like that. It's, you know, yeah, it's just the way it goes. All right, let's go to number 5 now. Okay, well, you have a good Thanksgiving.
You too.
Okay, we're going to talk about buying a duplex. Okay, we're going to talk about buying a duplex. A duplex has 2 places for people to live, right? So we're going to buy a duplex. So Felice bought a duplex apartment at a cost of $150,000. So I'm going to replace my number here. So I've got to go in and fix my numbers based on this particular problem. So I would write down the cost of the duplex. Okay, then they're going to give you the property mortgage payment. So when Felice pays for this property she bought, it is $940 a month. Okay, remember that's the mortgage payment for both of them together as one property. Then let's look at the real estate taxes. We get the real estate taxes by the year, but we want it by the month. Okay, so I put this out to the side. My real estate taxes are, and let me put this in because it's a different number than before. Okay, my real estate taxes are $1,440 divided by 12. Okay, so we've got to get that to a monthly amount. And they're just trying to make sure you are watching your timing timing of all these things. Okay, same with the insurance. The insurance is going to cost a certain amount per year, and then we want to divide that by 12 to get a monthly amount. Okay, so let me get that. Okay, so far we've got the monthly mortgage payment. We've got the real estate taxes by the month. We've got the insurance costs by the month. Now here comes a maintenance that she plans to spend. She estimates that she will spend $1,000 each year per apartment. How many apartments? 2, right? 2. Okay, so we have to, like I said, we have to go back and forth to try to understand what is going on here. So the maintenance per year for 2 apartments is going to be 2 times $1,000 divided by 12. Okay, so that can get a little confusing, right? Okay, and then the last piece is the costs for both duplexes. So you might as well just come down to the wire. How much is this whole property going to cost her? Okay, that's a good idea, because then we're going to divide that number by 2. And then that's going to be what she would, if she is going to break even. Okay, the term break even. It says, what monthly rent must she charge for each apartment to break even? So I think most of us understand that breaking even comes down to covering the costs, right? Just covering the costs. You're not making a profit. Okay. So now I'm going to put this number in here. I'm going to put my 1301.67 divided by 2. Because if I've got all this in here correctly, I've got the cost for both duplexes, which is the property, of 1301.67. And then we want to divide it by 2. So the break even rent per month per apartment is $650.83. You say, why would anybody go through all of that just to break even? Maybe maybe she bought this duplex for her nieces and nephews to live in. She doesn't really want to make a profit. She just wants them to pay enough to cover the cost. Do you understand? So finding out the cost of something per month is going to help her be able to determine how much rent she should charge. Along with knowing her costs, she would probably want to look around in the area this property is in and see what rental properties are going for, right? Because if she can make a profit on this, it just depends on her situation. She doesn't say anything about who those tenants are going to be or whatever. Okay, so, yep. All right, so this was number 5. So our break-even point is 6. Oh, and then they want it rounded to the nearest whole number. So I think this is correct. Does anybody have any questions over the different amounts we put in together? I just thought it was better to go ahead and figure out the property as a whole and then divide by 2. You know, you could start off dividing everything by 2, but I don't know. I just think that it's best just to line everything up for the property by the month. And then at the last step, divide by 2. You know, if there were 4 apartments, you would divide by 4 and so forth. Okay, so it just makes the most sense. All right, we're going to do this again now, but instead of breaking even, we actually want to make a profit. Okay, so same scenario. So you're going to line everything up to find out what your break-even point is, which we already have determined is $651. But now we're going to see that what is the rent you must charge for each apartment to make $2,000 in profit each year. Now, that is not per apartment. That's per the property. Okay, so here's what I'm gonna do. All you got to do is get down to that break-even point. We're going to take $2,000 and divide by 12. Okay, divide by 12 to know how much profit she wants to make per month. And then you would divide it by 2 to find out how much extra you would add to the rent for each apartment. Okay, so we went from 651 to adding 83.33. You say, where'd you get that? That's the $2,000 profit per apartment. Actually, it's for the property, but we're getting it down to per apartment. Okay, so I just want you to understand that you take the 2,000 profit, divide by 12, and then you would divide by 2 to find out how much extra to each apartment rent. Okay, so yep. So now we're looking at $734 per apartment per month, so that we would end up with about $2,000 in profit. Okay, and you could take any amount of profit after knowing your break-even point. By the way, this is an accounting problem, by the way. Break even, we learn in accounting, managerial accounting. And businesses use that break even point to analyze if you want a certain amount of profit, you know, what do you got to charge to get that? Okay, what's the price you've got to charge to get that? So hopefully this makes sense. Okay, all right. Number 7. Here comes some federal tax return deduction stuff, which can be a little bit challenging, but all right. It says, assume your home is assessed, that's the value of it, of $400,000. Okay, so I'm going to put that in. $400,000. Oop, not 4 million. All right. It says you have a $300,000 mortgage. So I'm putting that in my problem. $300,000 mortgage. Yep. For 30 years at 6%. Okay, I'm putting this down here beside the mortgage just so that 30 years at 6%. For some reason, I didn't put that down, and I usually put down the terms of a mortgage, right? So it is 6%. And okay, all right. And then it said, I know you got to find all the pieces here. So be careful. The assessed value is what the government entity, usually the county that you live in, it takes a look at all the properties in their jurisdiction and says, well, this one is worth this much. Now, a lot of times they do that assessment. They don't go inside. They don't look and see, is this place a Taj Mahal inside or is it a dump? Okay, so I guess they kind of make the assumption that however it looks on the outside, the inside probably mirrors that a little bit, right? So anyway, the assessed value. Now, so that you're only going to get taxed on your assessed value. It says your property tax is 1.5% of the assessed value. All right. So let's see here. I've got that here. I've got 400,000. I'm going to take it times 1.5%. So here is the property taxes that are owed here. $6,000 is owed of a property tax of 1.5% on a value of $400,000. So go ahead and figure that out. And then we're going to find our mortgage, how much interest we're paying a year, right? If this is simple interest, we're going to take 300,000 times 6% times 1 year. Okay, so if you have a 6% interest rate in 1 year, your mortgage interest for 1 year is 18,000, right? So if you take the two numbers together, the 6,000 of the property tax you paid and the 18,000 of the mortgage interest you paid, both of those are tax deductible. Okay, I'm going to put the words tax deductible. Tax deductible. Okay, those are homeowners benefits, homeowner tax benefits to encourage people to buy houses, right? Because there are studies that say those that own homes tend to be more model citizens or something like that. So anyway, the total deduction based on this information, when you add it together, is $24,000. You get to deduct that from your taxable income. So 24,000, not 240. 24,000 is the deductible amount, not the amount of taxes you're saving. No, this is the deduction that you can take because of that. Now you would need proof of all of that. Okay, so it's not just a matter of writing it down. Okay, now we're going to look and see, same problem. So we don't have to go back and do it again, but I need to fill it in here to get my numbers right. So it is $300,000 mortgage. Okay, and there's that total deduction. Now, here's the last piece you need. Assuming you are in the 28% tax bracket, what amount would you have lowered? By what amount would you have lowered your federal income tax? So now you need to take that total deduction times the 28% income tax rate. Okay, when you take 28% of that $24,000, then you get federal income tax reduction. This is how much it's saving you in taxes, okay? How much it's saving you in taxes. So $6,220 is how much in taxes you're saving by having a house with all these features, right? Yep. So it's reducing your federal income tax. And like I said, sometimes that gets a little bit confusing. All right, let's go to a rental. If Audra owns a rental house, she makes mortgage payments of $1,800. I'm going to write $1,800. I'm going to put $1,800 down in my problem, which includes insurance. Okay, so it's not separate. When she makes a mortgage payment, that pays her house insurance too, and pays $5,400 per year in property taxes and maintenance. So let's put in now for a year. Okay, hang on. So we're trying to get down to the charge for monthly rent to cover costs. So once again, we're trying to figure out the break-even point based on this information. So if $1,800 is being paid monthly, we need to convert that $5,400 to a monthly amount. Okay, so I'm going to take the $5,400 per year of more property tax and divide it by 12. Okay, so 5,400 divided by 12 is $450. And if you add that to the monthly mortgage payment, you get charged for monthly rent to cover costs. So if she's going to rent this place out, she would need to charge to break even $2,250 a month. Yep. So it better be a pretty, I bet it's, yeah. So there it is. There's the cost. If she wants to make a profit on it, she's going to have to charge more. Well, here it comes. Here it comes. How is she going to make that profit? So same break-even point calculation. So let me put this in here. What is happening here? Oh, I misspelled something and it just doesn't look right. There we go. Okay. All right. Monthly rent charged for how much of a profit? Annual profit. She wants a $3,000 profit. Okay. So let me change this to $3,000. Okay. Monthly mortgage payments. Once again, up here, we're using that information, 1,800. And then the property tax and maintenance divided by 12 is the 5,400 divided by 12. That's the 450 that we have right here. So we're just repeating what we did. Okay, and then there's that monthly rent. Okay, but now we've got to get down to, so this is the monthly rent. No, this is the monthly rent to break even. Monthly rent to break even. So that's the cost that she has. If she wants an annual profit of $3,000, then you need to take $3,000 and divide by 12. Okay, so if you take $3,000 and divide by 12, you get $250. So she would want to add the $250 to, okay, so then it would be $2,500 that she would want to charge for monthly rent in order to make a $3,000 annual profit, right? Just one more time for the road. If you take $250 times 12, you get $3,000. Yep. So she's got to charge that extra $250 a month if she wants that $3,000 profit for the year. So there's the rent charge for the desired profit of $3,000 a year. Okay. All right. This next one is about buying gold. Buying gold. All right. So precious metals. So it's a different kind of an investment. All right. So we're looking at in 2020, we purchased, okay, so let me get my timing right here. In 2020, we purchased 50 ounces of a precious metal. Oh, this is just a precious metal? So it's not gold now? Okay, they changed it. Okay, precious metal investment. Okay, we want to know what we paid per ounce. Okay, bought 50 ounces of precious metal for $1,750. Hang on. We've got to get an amount of how much. So she paid $1,750 for 50 ounces. So we've got to get an amount per ounce. If you take $1,750 and divide by 50, you get $35 an ounce. So I'm going to put $35 per ounce. Whoop. We need to know how much that was. So that's the purchase there. Okay, and and she bought 50 ounces, 1,750. So there should be your purchase. Okay, now it says he sold half the metal in 2022. All right, so just half of it, not all of it. 2022, gonna sell half of the metal. I don't know why they changed it. And then when you sell half of it, you want to only subtract half of it. Okay, so I'm actually going to take the purchase amount and divide by 2 because you're only selling half of it. There's why that was $875. Okay, so what is the value? All right, so now it's 2022 when the price was $45 an ounce. Okay, $45 an ounce. Okay, So this is the price now. And okay, so then we want 25 ounces equals 25 ounces times that $45 price. So if I've got this right, okay, this is going to be 25 ounces here, not 50. So you want to make sure that you're being careful with the amounts you're using. So one more time, we bought 50, or Juan bought 50 ounces of precious metal for $17.50. And I'm showing here that $17.50 divided by 50 is $35 an ounce. In fact, I'm going to move that down one. And then I want to show that that price was $35 an ounce on that same line so that we don't get too confused. 35 per ounce. Okay, and then what's the profit in 2022? Okay, 2022. So once again, just checking my math here. We purchased those 25 ounces times $35. Okay, yep. And then we turned around and sold those 25 ounces for $45 each, which means we have a profit of $250 in 2022. So let's put that in. Made a profit of $250. So how about the rest? Okay, the rest, it says, sold the other half in 2024 when the price was $55. Okay, so now we're going to sell the other half in 2024. And so, like I said, I'm taking out the word gold because they changed the problem, and that's okay. And now we want a 2024 profit. Okay, once again, $35 an ounce. Okay, versus $55 an ounce. So 25, they said $55 an ounce, $55. Okay, and so let's do the math here. Okay, that's good. 25 times 35 is the 875. And then the 25 times 55 is the 1375. 1375. Okay, so when he sold the first half, he only made $250, but the second half, he made more than that. Okay, he made $500 on that second half of that. So you just got to kind of make sure you're looking at the same number of ounces, right? Okay, we're going to do this some more now. All right, so just a little bit more and we'll be finished up. Okay, number 12, the one, so we're going to think we're going to do some more now. Okay, and I'm going to make it follow what it's saying here. Precious metal investment. Okay, so it says in 2020, Juan bought 50 ounces. So we're using that same scenario for 1750. He sold half the metal. Okay, is this the same one? Wait, oh, no, it isn't. Hold on. All right. So okay, 50 ounces. So what about 50 ounces? 50 ounces of gold, right? Cost him, when he bought it, 50 times 35, it's the 1750, right? Which is the $35 cost. Well, what if it's 55 in 2024 and he sold it all in 2024? Yep. So I'm going to put $55 here. And this is all, if he did all of it, well, he would have made more money. Yeah, because the the sales price of the new value of the metal went up in 2024, higher than it was in 2022. So he would have made a profit of $1,000, I believe, but I'm just going to do the math here. So 50 times 55. Okay, let me put the equal sign here. 50 ounces, that's the total ounces we have, times 55. Yep. So he would have sold it for $27.50. He would have subtracted his purchase. So he would have made $1,000 profit if he would have held it all until 2024. But how do you ever know? I mean, you have to have a crystal ball to be able to predict that. Okay. Let's do a couple of others now. Now we're going to be working on gold. Okay, Prima purchased 15 ounces of gold in 2025 or 2005. Okay, so let me put 15 ounces here of gold at $4.22 an ounce. Okay, I'm putting it in just exactly what it is. So we purchased 15. All right. So we need to know how much it is. So $4.22 an ounce. So I'm going to put $4.22 here. Okay, now it says she sold a third of her holdings in gold in 2009. Okay, so a third of 15 ounces is 5 ounces, right? Okay, a third of it is 5 ounces. So we got to make sure to use 5 times 822, and then 944. Okay, here's what we need. When we purchased it, we're going to take 5 ounces times the 422 price. Okay, remember $4.22 an ounce is how much. Let me put the dollar sign in front of this 422 so you recognize that. So 5 times 422 is a purchase of $2,110. Then 1/3 of it, right, which is the 5. Okay, 5 times the 944, which is right here. There is how much he sold. And he made a profit in 2009. Okay, so the first profit is $2,610. Okay, now we're going to, she sold the rest of her gold in 2010. So the rest of it is 2/3. So that's 10 ounces. Okay, and we're using the 422 price. But the price is $12.54. So wow. So she sold the rest of it. So we've got 10 ounces times the price of $1,254. She bought it for $422, those 10 ounces. So she's got a very sizable profit there, $83.20 on. Yeah, she should have waited until 2010. Okay, let's see if they ask. Yeah. So now they want to know what it would have happened if she would have sold it all in it says, what would be her profit? What would her profit have been if she sold all the gold holdings in 2009? So just using the 944 price. And this is going to be sell all. Okay, and all is 15 ounces. 15 ounces. Okay, so 15 ounces, and she bought it for $422. So we want, yep. And then 15 ounces times 944. If she would have sold all of it, make sure I've got it right, 15 ounces times 944, she would have had a profit of $10,362. Okay, $10,362. And then I think the last one is, well, what if she would have sold it all in 2010? Uh-oh, hang on. What does it say here? I probably messed up something here. Let me try it. Okay, 14. Oh, well, okay, 14. Here it is. Okay, one more time. 15 ounces. Okay, 15 ounces times 422. We're using that same problem each time, 422. Okay, so 15 ounces times 944, which is what the price was in 2009. Okay, and then, here we go. Here's where I went wrong. Here we are. So then we take 15 ounces times 422. Profit is 7,830. There we go. 7,830. Now let's do the very last one. So what about all of those ounces, right? Selling at a 12.54. Okay, and then that purchase. Yep. So here's where she would have made the most profit, right? By waiting to sell all of the 15 ounces in year 2010, when the price of gold was the highest at $1,254 an ounce. So she would have made $12,480,000 if she would have waited. But what if the gold price would have went down that next year? Then she would have made less. So there you have it. I'm going to stop my video. Okay. And then I'm going to finish up real quick